Good noon to everyone. Today we are going to discuss about a very interesting topic, that is your financial structure and leverage, which the financial structure refers to the composition of a company's capital, including the proportion of equity and debt financing used to fund its operations and investment. But leverage, on the other hand, refers to the degree to which a company utilizes the debt financing relative to equity financing. So there is a difference between your financial structure and the leverage which is going to be used. So the financial structure companies are equity financing and debt financing. First is regarding your equity financing, which involves raising capital by issuing shares of ownership in the company to investors such as the common stock or preferred stock. So equity represents ownership interest in the company and does not require repayment, but the shareholders typically they require the repayment to be done for them for their voting rights. So next one is your debt financing, which involves borrowing funds from creditors such as banks, bondholders, or other financial institutions. So debt obligation, loans, bonds, or the credit represents contractual obligation, thus must be repaid according to the agreed payment. The next is your financial structure ratios, that is your debt to equity ratio, debt ratio, and equity ratio. So debt to equity ratio tells about the strength of your capital structure inside an organization. So that this ratio calculation helps us to identify the best capital structure a company forms and which will gain them with your revenues, higher revenue. So the stronger the debt equity, the higher will be the level of your income and the risk involved will be less. And then debt ratio measures the proportion of a company's assets that are financed with the debt. It is calculated by dividing the total debt by total assets. So the higher the debt ratio, it indicates the greater reliance on the debt financing to fund operations and investment. Next is your equity ratio, which measures the proportion of a company's assets that are financed with equity. It is calculated by dividing total equity by the total assets. So when the higher the equity ratio, automatically it indicates the lower level of financial risk, as the companies has a large proportion of equity relative to debts. Next is your financial leverage. As discussed earlier, the degree in which they are going to utilize is the leverage. So here we have financial leverage and operating leverage. Financial leverage refers to the use of debts financing to magnify returns on equity investment. By using debt, companies can amplify their returns on equity capital when the return on assets exceeds the cost of debt. Then operating leverage refers to the use of fixed costs such as depreciation, rent, and salaries to magnify changes in operating income, that is EBIT, in response to the changes in sales or revenue. Companies with high operating leverage have higher fixed costs relative to variable costs, resulting in the greater volatility in the profits as sales fluctuate. Then next is your risk and consideration. Financial risk as well as your cost of capital. Financial risk, higher level of debt financing increases financial risk, such as company must meet the interest payments and debt obligations even during the periods of your economic downturn or reduced cash flows. Then cost of capital. The cost of capital reflects the required rate of return demanded by the investors to compensate for the risk associated with the investing in the company's equity and debt securities. So the companies with a higher level of leverage may have higher cost of capital. So that is the case. And then capital structure optimization. Companies aim to optimize their capital structure by balancing the benefits of the debt financing, that is tax advantage, leverage effects, with the cost and risk associated with the debt. The optimal capital structure varies depending on factors such as industry dynamics and then business risk, growth prospect, and investor preferences. So in this video we have discussed enough about the various risk considerations, okay, and your capital structure optimization, etc., regarding the financial management. So in my series of your 10 videos, you must have understood thoroughly about your financial management and the various risk, various markets, the short term and long term utilization, investment alternatives. We have discussed enough about your financial management and also the basics regarding your meaning, goals and objectives, importance of your financial management, etc., which will be much helpful for you to your studies. So kindly keep in touch and support to my Learn to Win channel for their further videos. Kindly ping me regarding the topics which you need for more discussion, so that can be further discussed in your next videos. Okay, comment and give the suggestions for the further topics. Thank you for listening to the further videos. Keep in touch. Thank you so much.